Good morning, everyone. Welcome to today's tax seminar of Grant Thornton. I am Motoaki Araki and facilitating today's seminars. I have been worked for more than 4 years with GT India and this India-Japan corridor. Today's seminar is co-organized by GT Japan and GT India. We covered 4 topics today, and it's presented by GT Japan and GT India's tax experts. Later, I will introduce each speaker. After speaker's presentation, we have Q&A session. And if you have any question, please click that Q&A tab and write your question. So let me start from corporate income tax compliance in Japan, which is presented by Michiko Shinohara. She's a partner of Grant Thornton Japan and certified public accountant in Japan. She has more than 16 years experience to provide both tax compliance and consulting services for multinational clients in Japan. She mainly advises on the permanent establishment issues, Japanese corporate tax, consumption tax, and withholding tax issues. So please start your presentation, Shinohara-san.
Thank you. Thank you very much. Hello, everyone. Thank you very much for attending this seminar today. So my name is Michiko and a tax partner of Grant Thornton Japan. I specialize in foreign companies setting up operations in Japan, and I have many clients with Indian subsidiaries. In this seminar, I will explain through my experience the point that Indian companies which have branch or subsidiary in Japan should pay attention to today. First of all, I have made a case, so I will explain based on this case. Next slide, please. Next slide. Next slide, please. Yes. So this is one case. The Indian company S provide ID technical services to domestic company A. The employees of Japanese branch of S company visit Japan company A to carry out maintenance and repairs to the software located in Japan. Head office of S company is mainly responsible for all software development, while some repairs are also carried out in India. Company A contracts with S company and pays for all services to branch S. Branch S pays the head office at a later date the development and repair carried out in India. So this time I will pay attention to the treatment of technical services in Japan, because a lot of Indian clients is providing a technical services in Japan clients. So this tax is really special case in Japan by applying not only for the domestic tax rule, but also a tax treaty between India and Japan. Next slide, please. Let me first explain the treatment of Japanese domestic law. So if a foreign company performs any of these 3 services, I wrote in the light green, listed here in Japan, the fee received for these services is subject to Japanese corporate tax and withholding tax as Japan source income. The withholding tax rate is 20.42%. The technical services mentioned in this article fall under the 3rd category of services listed here. So the 3rd category is the businesses whose main activity is the provision of services by persons which expert knowledge or specialized skill in science and technology, business management or other fields by making use of such knowledge of skills. The key point to note here is that only the services provided in Japan are subject to Japanese corporate tax and withholding tax. Next slide, please. Okay. However, Under the tax treaty between India and Japan, on the other hand, for technical services, the source of income is determined by where the payer is located, regardless of where the services are rendered. Please see the left side of the slide. So Article 12, number 6 of the India-Japan Treaty, tax treaty states that royalties and fees for technical services shall be deemed to arise in a constructing state when the payer is that constructing state itself. As noted on the right-hand side of the slide, domestic law also stipulates that the source rule of the tax treaty shall prevail. As a result, tax treaties take procedure and, in the case of businesses providing technical services, all the fee paid by the Japanese company to an India company is subject to withholding tax at the rate of 20.42% and corporation tax, irrespective of the place of provision of the services. In extreme cases, if the payer is the Japanese India company, even if it does not have a branch in Japan, it is subject to withholding tax and corporate tax in Japan if the payer is Japanese company. Next slide, please. This section takes a closer look at the Japanese withholding tax system. In Japan, if a certificate of exemption from withholding tax is issued by the tax officer, and this exemption certificate is presented to the payer, only foreign companies who have a permanent establishment in Japan are exempt from withholding tax on the certain domestic source income paid within the period of validity of this certificate. We call this system withholding tax exemption system. Domestic source income subject to this withholding tax exemption system are limitedly listed in the article, and technical service is in the scope. However, this system is limited to domestic source income attributed to a permanent establishment, and specific domestic source income attributed to a head office outside the country is not subject to the withholding tax exemption system. In fact, in the past, if there was a branch in Japan, not only income attributable to the branch, but also income attributable to the head office in India was eligible for exemption from withholding income tax if it was a domestic source income subject to this exemption system. However, in recent years, due to the BEPS trend, the nature of income of Japanese branches has changed, and the withholding tax exemption system has also been amended to be limited to income attributable to the Japanese branch. So if there is some client, Indian company, which used to be exempt for all the income, definitely the Japanese withholding tax treatment was changed. So please pay attention to whether this income is attributed to the branch or head office. Next slide, please. Furthermore, I would like to discuss withholding tax rate. Under Japanese domestic law, a withholding tax rate of 20.42% applies to technical service fees paid to foreign entities. However, under the India-Japan tax treaty, the rate has been reduced to 10%. And it is important to note that the India and Japan tax treaty applies to both individual and corporate income tax. So the 10% limit applies not only to withholding income tax, but also to corporate tax. Please see the below 3 cases. So withholding tax, if there is a gross sales amount, 10,000, withholding tax amount in Japan is 20.42%. So 2042 is a Japanese withholding tax. But by applying tax treaty, it can be reduced to 1,000. And also, case 2. This is the most important thing. So this 10% is applied to also in the corporate tax. So for example, if the gross sales amount is 10,000, but taxable income is 5,000, Japanese national corporate income tax is almost about 26%. So 1,279 is the Japanese corporate tax in case. But by applying tax treaty, there is a 1,000. So in this case, the company can only pay the 1,000 portion. And it is most important thing is that please see the case number 2. So even if the amount of Japanese corporate tax exceeds the amount of withholding tax, if the withholding tax paid and no additional tax is payable and no penalty is incurred. So there is many cases of Indian companies without a branch in Japan that are only subject to withholding tax and do not file a corporate tax return. However, as in case 3 is also the same of the corporate tax case, but the taxable income is extremely lower than a case 2. So when taxable income is low, there is the possibility when the company income tax is significantly smaller than the withholding tax. In such cases, the withholding tax can be partially refunded by submitting a corporate tax return. So it is therefore recommended that the company may better consider submitting the tax return after carefully assessing your company's situation and the number of the Japan business. Next slide, please. Finally, I will introduce one more case. The difference with the previous case is that the Japanese branch is becoming a subsidiary company. So the case 1 was that the India company set up the branch, but this time the India company set up the subsidiary. And subsidiary directly make a contract with a Japanese company A. And subsidiary also make a contract with a parent company in India. If a Japan is a subsidiary, withholding taxation does not arise between the 2 Japanese entities. So there is no withholding tax on payment from the Japanese clients to the Japanese subsidiary. Payment from the India subsidiary to the Indian parent company are subject to withholding tax at 20.42%, which is reduced to 10% under the tax treaty. So in this case, payment from A to subsidiary of S company, SS, is no withholding tax. But the SS company paid to parent company, S company, this is subject to the withholding tax. And the most important matter in this case is not the withholding tax, but the corporate tax. The most, I have to explain about the most important things. So that I told that the national tax is if there is the India company has a branch in Japan, whether this is attributed to the branch or head office, all the income, Japan source income is subject to not only the national tax, but also the local tax. However, if the India company, which do not have a branch in Japan, all the income, Japan source income, or service provided in India is only subject to the national tax and not subject to the local tax. Local corporate tax in Japan includes various income taxes and also has a tax per capita basis. Therefore, there is an additional tax of approximately 6% to 15% if applied. So Japanese national corporate tax rate is approximately 26%. When local corporate tax is added to this, the Japanese corporate tax rate increases to between 32% and 40%. Next slide, please. Finally, a summary of the issue raised in my presentation has been prepared. I will highlight it to the orange to the point that this is very important. Finally, as can be seen, taxation in Japan varies considerably depending on the type of Japanese operation. I hope that my explanation will help you to gain a deeper understanding of this issue. I'm really sorry for interrupt for the in the middle, but I will happy to go to next to the Sidaru-san of this seminar. Thank you very much, Sidaru-san.
Thank you, Shinohara-san. So, as the audience can see, the choice between a branch and a subsidiary has its own implications in Japan. It also has corresponding implications on how tax credit flows in India. So let me now walk you through the basic provisions of availing tax credit in India or foreign taxes paid. So if we were to go to the next slide, as you can see, Section 90 of the Income Tax Act enables an Indian taxpayer to claim credit of tax paid in a foreign country to avoid double taxation. The taxpayer has the option to be governed by the provisions of the Income Tax Act or the relevant double tax avoidance agreement, whichever is more beneficial. And this is embedded in the income tax law itself in Section 90. Foreign tax credit is available as a credit against the income tax payable, which is computed under normal tax provisions of the domestic law, or the MAT, or what we call the minimum alternate tax, which provisions are enshrined in Section 115 JB of the Income Tax Act. Interestingly, income tax by definition excludes any interest, fee, or penalty that is paid over and above the tax liability. And I will come to the element of how state tax is interpreted for the purposes of meaning of income tax in a short while. Now, credit of foreign taxes is available in the year in which the income corresponding to such tax is offered to or assessed to tax in India. When income on which the foreign tax has been paid or deducted is offered to tax in more than 1 year, credit is also allowed on a proportional basis to the income that is offered to tax. In order to claim the credit of foreign taxes paid, the Indian company is expected to file Form 67, which is essentially a statement providing that the income received from the foreign country has been offered to tax, and also provide documentation that justify that the tax have been deducted in the foreign country, as well as the entity is a tax resident of that country. For example, a tax residency certificate in this case. If you were to move to the next slide, what we see in the next slide is the fact that Article 23 of the India-Japan Treaty says that the amount of tax payable shall be allowed as credit against the Indian tax payable in respect of such profits or income, provided that the credit is not exceeding the income tax as computed before allowing such credit, and which is attributable to the income which may be taxed in Japan. Now the term Japan tax payable includes amounts of tax in Japan which would have been paid if the Japan tax had not been exempted or reduced in accordance with the treaty or the existing taxation law in Japan, along with future modifications, if any. And foreign tax credit is designed in such a way that it would allow foreign investors to reduce the tax in this manner. So this can be done in two ways. First is the full credit, where, for example, India allows the deduction of the total amount of tax paid in, say, Japan on the income which may be taxed in Japan. And the second is ordinary credit, where the foreign tax credit is restricted to that part of the tax that India on which Japan taxes that income. So let me take an example that Shinohara-san had earlier taken. So for example, in case one where the entire 10,000 was offered to withholding tax in Japan at the rate of 10%, an amount of 1,000 is available against the tax liability of the income of 10,000 in India. That is, in India, the tax rate, assuming that it is 25.17%, this would amount to 2517. So the net tax that would be paid in India would be 2517 minus 1,000. The other two cases are the interesting pieces in the equation, where only 5,000 or 1,000 is offered to tax in Japan, in which situation the tax credit is limited to 1,000 or 255 as the case is, on which the tax credit is then limited to 25.17% of 5,000 or 1,000. That means 1259 or 252 in the alternate examples. In both cases, as the national corporate tax rate of Japan, that is 25.58, is slightly higher, or in some cases could be lower than the corporate tax income tax rate in India, there is some leakage that you have to plan for, which needs to be carefully evaluated. It is therefore very important to attribute expenses to Japan in the right manner. And needless to say, transfer pricing on the income side will certainly play out in a very significant manner. Now, if we can move to the next slide, unless the slide deck is not visible to others. Yeah, so if we can move to the next slide, I have put out a few logical issues that we have seen in practice that are coming through in what we have seen, particularly in Japan. So for example, the first question is, where an income is exempt from Indian tax by virtue of the domestic law, whether the amount tax paid in Japan is available as credit in the Indian entity. Now, the Indian courts, especially the Karnataka High Court ruling of Wipro Limited, has held that tax credit of tax paid in a foreign country can be claimed even though the income is exempt from tax in India as per income tax provisions. Therefore, the argument to allow the credit of taxes was that even though such income is exempt in India, it is subject to tax and no tax is charged on account of exemption granted under the domestic law. Accordingly, tax credit is allowed. Note that there is already a special leave petition filed by the Income Tax Department pending with the Supreme Court of India on this matter, and this has been accepted, and hence the matter is not still free from litigation. So even companies that have branches can take credit of tax paid by the branch abroad while computing their tax liability in India. And this is again a Bank of India Mumbai tribunal case which supports this situation. The next issue is where an Indian company has losses in a financial year, and if there are taxes that are paid in Japan, what happens to, is there a possibility to claim a refund in India on such a scenario? In such a scenario, income in India is not subject to tax due to the loss, and therefore the credit available to taxes paid in Japan may not be available, as the income never gets subjected to tax in India. Hence, a refund of foreign taxes would not be available in India. And this is what the Mumbai Tribunal, in the case of Bank of India, as well as in the matter of the Mumbai High Court in Reliance Infrastructure, has kind of put out. But this is again subject matter of litigation. But as it stands today, these two cases that determine the basis on which you can claim this credit. Now, the next question is whether amount of foreign taxes paid which are not allowed as credit in India can be claimed as expense, or can they be expensed at all? Now, tribunals and courts have held that amounts of taxes paid overseas in foreign jurisdictions are not eligible as credit. That are not eligible as credit cannot be claimed as expense, as a tax paid is covered within the expression of tax under section 40A double I of the Income Tax Act. Now, this has also been held true through the Ahmedabad tribunal judgment in Elite Core Technologies Private Limited. And therefore, section 90 cannot override for this purpose the provisions of the domestic law. If you go to the next point, if you were to avail foreign tax credit in India, Form 67 has to be filed within the time limit prescribed in the Income Tax Act. However, certain unforeseen circumstances can lead to the form being filed after the time limit is prescribed, and whether foreign tax credit of tax paid in the foreign country will be allowed in such a circumstance. Now, it is recommended that you comply with the applicable provisions of the Income Tax Act to file this form within the time limit prescribed by the Act itself. However, there are some supporting judgments, especially the tribunal in Bangalore in the case of Hertz Software India Private Limited, which has held that an Indian company filing Form 67 after the due date, but during the assessment proceedings, will be allowed to claim the foreign tax credit. And since filing of Form 67 is a procedural requirement and not mandatory, there is no violation of the underlying right of claiming the credit of foreign tax. However, in the course of assessment proceedings, documents that are produced in the other country, for example, the certificate specifying the amount of tax deducted, should certainly need to be submitted before the tax authorities to claim the foreign tax credit. We have an interesting case which is useful for partnership firms to know that if you are a partnership firm operating in India and you're rendering professional services to Japanese clients, whether foreign tax credit withheld in Japan, will it be available for you as a partnership firm in India? Now, the India-Japan Treaty, professional services earned by partnership firms would be considered as income falling under Article 12 and not under Article 14, that is independent personal services. And accordingly, credit of foreign taxes paid will be allowed to the Indian partnership firm. This has been held true in the matter of Amarchand Mangaldas, Suresh and Shroff on this matter. Lastly, I think Shinohara-san spoke about this, but it's important for me to ask that question, that if an Indian company had a branch office in Japan and there are federal and state taxes that are paid by the Japanese branch office, whether foreign tax credit can be claimed on taxes paid for profits that are earned, both the federal as well as the state tax. Now, under Article 2 of the Indian-Japan Treaty, only federal taxes are covered and state taxes are not covered. But there have been judicial precedents that have held that credit of state taxes can alternatively be claimed as a deduction under Section 91 itself. And this has been upheld by the High Court in the matter of Wipro, and also in Mumbai Tribunal in the matter of Tata Sons Limited. So Section 91 actually does not discriminate between state tax and federal tax. And therefore, there is this possibility to claim state tax under domestic law provisions of Section 91. A strict interpretation of 91 also suggests that the relief cannot be claimed in respect of taxes paid in a country in which India has a treaty. And therefore, because India and Japan have a treaty, this is not subject matter of a clear answer. And therefore, claiming credit of state taxes under Section 91 will be a litigative kind of an issue. With that, I come to the end of my part of the presentation, and I would be happy to take specific questions at the end of the seminar. Over to you, Araki-san.
Yeah, thank you, Shuriya-san, for explaining of the typical issue for the taking foreign tax credit in India. And then third topic is transfer pricing compliance in Japan. It's presented by Katsuhiro Asakura. He is a CPA in Japan. He has worked at Grand Thornton Japan for more than 10 years and been providing various transfer pricing related services, including documentation and APA and tax audit support. So Asakura-san, could you start your presentation?
Hello everyone, I'm Katsuhiko Asakura from Grand Thornton Tokyo office. I'm very happy to see all of you. I'm going to talk about basic TP compliance in Japan. Now let's begin. Next slide. Japan has a 35-year history of transfer pricing. The tax investigators are familiar with transfer pricing regulations and have a lot of experience conducting TP assessments. The tax authority adheres strictly to the rules set by the OECD in regards to TP. The TP administrative guidelines set by NTA are in accordance with the OECD TP guidelines. You should follow transfer pricing guidelines set by the OECD, but not those set by the United Nations. Next slide, please. Before transfer pricing rules were established, NTA used the tax law's treatment of donation transactions for assessments to foreign affiliated transactions. Note that the treatment for donation still exists. TP taxation and donation taxation are carried out using similar mechanisms, and both can result in double taxation, but the consequences are not the same. Where donation taxation has been imposed, there is no relief procedure available to eliminate double taxation. The mutual agreement procedure for resolving double taxation is only applicable to transfer pricing. Next slide. The donation rules. It is challenging to anticipate whether a tax investigator will use TP regulations or donation regulations for an assessment because the distinction between this is unclear. These are typical examples of donations: free of charge transactions, transactions that differ from the contract, payments of supportive natures. Please note that voluntary adjustment on tax return is not applicable map as well. Next. Transfer pricing calculation should be performed using the method specified in the relevant legislations. Acceptable transfer pricing methodologies, including the following: cut method, compare with price; RP method, compare with gross margin; CP method, compare with cost markup rate; TNNM, compare with operating margin. For example, return on sales, full cost markup, and BERI ratio. Profit split method, split operating profit, and DCF. DCF is a popular variation method for enterprise value and intangible assets. So the Japanese tax authority preferred the TNMM for transfer pricing assessment. Achieving an appropriate level of operating profit is the best way to avoid transfer pricing taxations. I recommend conducting a benchmarking study for your subsidiaries in Japan. Next, please. Tax investigators tend to favor using local Japanese companies as a comparables in transfer pricing assessments. Tax investigators select comparables through commercial financial database such as Bureau van Dijk, VVD, and Standard & Poor's S&P. Japan has a well-developed stock market, and thousands of companies from various industries are listed. Tax investigators consider local comparables to be easily accessible and sufficient for their assessments. Where the tested party is Japanese entity, it's better to use Japanese local comparables for benchmarking study. Next. Next, arm's length range. The National Tax Agency, Japanese Tax Authority, has a more lenient definition of arm's length range compared to the Indian Tax Department. Japan, from 25 percentile to 75 percentile. India, from 35 percentile to 65 percentile. Next, please. Intra-group loan. Japan's transfer pricing administrative guidelines were reformed last year, aligning with the OECD guideline reforms. Previously, the administrative guideline provide the following safe harbor methods. First method, borrower's credit risk premium plus currency risk premium. Second method, lender's credit risk premium plus currency risk premium. Third method, only currency risk premium. For example, the yield on the government bond. The current administrative guideline only accept method 1. This reform requires the tax investigator to conduct a more precise economic analysis. They can use commercial database such as Icon, Capital IQ, Bloomberg, etc. to determine borrowers' credit ratings. This reform could be seen as beneficial for taxpayers in terms of increased transparency and predictability, but it's also come with increasing compliance cost. The database can be expensive. It would be important to weigh the cost and benefit when setting the interest rate. Next slide. Tax return documentations. Schedule 17-3. This is tax investigator use schedules 70-3 for high-level risk assessment and determine their investigation targets. Local file must be submitted no later than 45 days from the time of the investigator's request. Failing to submit a local file could prevent the use of mutual agreement procedure to resolve double taxation. The parent entity's local file can also be used for compliance purpose in Japan, but we recommend reviewing and localizing it for use in Japan. Master file and country-by-country report. The rules for the master file and the CBCR are consistent with OECD guideline Article 5. The threshold is 100 billion Japanese yen of total consolidated revenue. This has been extended from the OECD rules of 750 million euros as well. That brings me to the end of my presentation. I'd like to hand it over to Mr. Rajiv Jain.
Thank you, Asakura-san. Before starting the presentation of Rajiv Jain, I would like to give his introduction. And the last agenda is point for consideration, Indian TP perspective. Rajiv Jain is chartered accountant and TP expert. He is also the part of India-Japan corridor practice. He has more than 20 years TP practice in India since its introduction by Indian government from 2001. He has worked on various TP assignments, including compliance, documentation like CBCR, master file, and local file, and business model pricing structuring. In addition, he has extensive experience in TP litigation and MAPs and APA. So now, Rajiv-san, please start your presentation.
Thank you, Raki-san. Thank you so much. I hope I am audible. Raki-san, if you can just confirm that.
Yeah, yes.
Great. Thank you so much. And I will request for next slide, please. It's not moving on my laptop. Yeah, thank you. So thank you, Raki-san, once again, and thank Asakura-san to give us some flavor of transfer pricing regulations of from Japan perspective. In India also, transfer pricing law was a little old. It was introduced way back in 2001. And since then, any MNCs having any international transaction with their subsidiaries or good companies overseas needs to do a various compliances. Besides CBCR and master file, there are two major compliances which needs to be done. One is accountant report and another one is transfer pricing documentation. So, so if you as an Indian MNC having a transaction with your Japanese subsidiaries, and so you need to do both the compliances on an annual basis along with the CBCR and master file wherever it is applicable. One of the point which is relevant to understand here that since my colleague have been explaining about the permanent establishment and the branch office in Japan, one point needs to understand whether any transaction between the Indian MNCs and the branch office in Japan or the permanent establishment in Japan is subject to Indian transfer pricing regulation. The answer is no, because for Indian income tax perspective, Japanese branch will not have any separate legal entity. So transfer pricing regulation will not applicable on those transactions. I also would like to talk about some of the unique transaction and based on our experience, which we have seen most litigative one between the Indian MNCs and the headquarters and the branch office and the subsidiaries overseas. So one of the transaction is free of cost transaction. So Indian MNC is providing any services free of cost or any financial facility to the overseas subsidiaries free of cost, or providing technical know-how or allowing them to use their brand free of cost. Then Indian tax authorities have been aggressive and trying to ask for a arm's length remuneration. Unless until you can prove that these support services which you are providing free of cost are shareholder or stewardship type of activities, you'll not be able to defend that kind of a transaction. So advice is to do a proper analysis, do that. Second point which I would like to explain is regarding the management support services. Whenever Indian MNC is providing management support services to overseas group companies, including Japan subsidiaries, we need to be little bit more cautious and need to understand how it has been done. So one of the point is we should be very clear on the pricing model, whether it should be a cost plus or revenue split or some other parameter for the arriving at the correct transfer pricing models. I'll give you an example, like, if Indian company is providing marketing support services to Japanese subsidiaries, the question is whether you should go for a cost plus pricing or you should have a ROS, return on sales method. It's also depend upon the intensity of marketing function being provided by the Indian company. Second step is within the management support services is, if you are comfortable with the pricing model, and let's assume this is a cost plus is the perfect model, you need to ensure that all cost, not only the direct cost, but also the indirect tax and indirect cost and the other overheads is also to be considered for arriving at that total cost. It needs to be allocated based on the appropriate allocable parameter. So for example, if you are dividing the cost which is pertaining to the HR related cost, then the parameter can be number of manpower. If you are allocating some kind of a marketing cost, then sales can be the appropriate parameter of allocating that cost. Once the allocation is done, then you will also have to have calculated the arm length markup. So for that purpose, you need to do a proper benchmarking exercise, relying on Indian comparables, because Indian entities providing all those services to overseas group companies. The range which my colleague Asakura-san have already explained, like from Japanese regulation perspective, it is 25 to 75 percentile, but from India perspective, we need to be cautious. We can use the range of 35 to 65 range percentile. Another typical transaction is royalty transaction, where Indian companies providing know-how or the brand to the overseas subsidiary company. Then appropriate arm length remuneration, arm length royalty rate should also be computed based on the various databases. Now here I would like to mention specifically that, and when my colleague Asakura-san was explaining that from Japan regulation perspective and the Japanese tax authority perspective, they generally go by TNMM as most appropriate method. So assuming that royalty transaction from Japanese transfer pricing documentation perspective, they have applied TNMM as most appropriate method. But from Indian transfer pricing regulation perspective, you need to go for a transaction-wise approach. So you will not be able to rely on Japanese profit and loss account and Japanese profitability. You need to do a transaction-wise analysis and come out with a robust transaction-wise analysis using comparable royalty rates. Similarly, for financial transaction, if Indian MNC is providing financial facility or equity or the debt to the foreign subsidiaries in Japan, then those transaction also needs to be at arm's length. So if you are issuing capital or if you are investing in the capital of the subsidiaries, that valuation needs to be done. If you are providing funds to the Japanese subsidiaries, the interest rate, you need to be careful on that. And you need to benchmark that interest rate. You can use Indian safe harbor, but from Japan regulation perspective, in any case, you will have to do that benchmarking. So my suggestion is that go for individual transaction benchmarking, even in those cases wherever you want to rely from Japanese regulation perspective, TNMM as most appropriate method. But if these kind of unique transactions which are there from Indian MNC perspective, you will have to do a transaction-wise analysis. So my overall point here is that, and I will not take much time in the interest of the time, my overall point here is that though Japan also has transfer pricing regulation and India has also transfer pricing regulations, but you need to be very careful. Like you can definitely rely on the benchmarking approach adopted in one country, but it is not always possible to rely on one documentation So it's very, very fact specific. You need to be a little careful on that. One transaction may be at arm's length from one regulation perspective, one country's regulation perspective, but may not be at arm's length from the other country's regulation perspective. Yeah, so that's it from my side. Araki-san, in the interest of time, I've just finished a little earlier. Request if you can take the webinar forward.
Yep. Thank you, Rajiv-san, for giving us insightful consideration point by using the examples. So I would like to move to the Q&A session. So all the speakers, Asakura-san and Rajiv-san, Sridhar-san, Shinohara-san, could you turn on your camera? And I got some questions, so let me request our expert to clarify these questions. So our first question, what is the definition of income attributed to permanent establishments in Japan? So could you, Shinohara-san, take up this question?
Okay, Alexa, thank you very much. Yes, this is very important question. It's very good question. So Japanese tax law, corporate and income tax rule mentions to determine the income to be attributed to the permanent establishment, taking into account the functions performed by the permanent establishment, the asset used in the PE, the transaction between PE and the head office in case branch is deemed to be a different entity from head office. This means that, the definition is very abstract and cannot be judged on concrete, clear criteria such as location. Therefore, even if, as I explained in my seminar case 1, the branch received all the services fees from the Japanese clients, if the place of rendering of services responsibilities are all at the head office in India, then the income cannot be said to be income attributable to the branch. Recently, actual tax audit in Japan pay high attention to the invoice relating technical services provided by India company. This is not only the India company of the parent company or head office, but also provided by the subsidiary of India or the branch of the India company. And not only the cases where the head office and branches issue their own invoice, but also in many India companies where the Indian branches issue invoice together, but list the head office and branch separately, which is also increasingly being questioned by the tax authorities. Please note that the issue of attributable income to head office or branch office is closely related not only to the definition of income of corporate tax purposes, but also to the detail of transfer pricing and consumption tax. So I really suggest to consult the specialist for these kind of the matters carefully. Thank you.
Thank you, Shinohara-san. So I would like to take next questions. What is the procedure to compute the amount of foreign tax credit eligible to be claimed? So Sridhar-san, could you answer this question?
Yeah, sure, Araki-san. So foreign tax credit under income tax law in India, read with treaty, is eligible. The amount that is eligible to be claimed is the actual taxes paid for each source of income compared to the amount of income tax that is payable on such source of income as per Indian tax law, which is either the normal provisions or the MAT provisions, whichever is lower. So, so what happens here is that if there is foreign tax paid that is in excess of the amount of tax that is payable in accordance with the treaty, that tax needs to be ignored, which means that you will not get credit of that tax. And therefore, the most logical thing for you to do is to claim a refund in Japan of such an amount. It's also important to make sure that the right amount of income is actually claimed in the respective jurisdictions, because that will decide how much of tax credit is the entitlement. Now, as foreign taxes are paid in foreign currency, there's also a requirement to convert that currency to Indian currency, which is based on the buying rates on the last date of the month immediately preceding the month in which the tax was deducted. So broadly that, but suffice to say that because the tax rates between India and Japan are, or Japan is slightly lower in circumstances, but India is almost just about 25.17 in effective rate as compared to 25.58. There is not too much arbitrage loss that is applicable if the income in Japan itself is much lesser than what is attributable. So there is some planning that can be done, but this is significant to also take a decision on whether you should be a subsidiary or a branch. Yeah, thank you.
Thank you, Sridharsan. And sorry for the audience which raised the question, but time is up, so I would like to conclude today's seminar. After the seminar, we will respond to each questions separately. Thank you for attending today's tax seminar collaborating GT Japan and GT India. I hope it is useful for Japanese business. Thank you very much.
Thank you very much.
Thank you.
Thank you very much.
Thank you.